Share screen. Okay, good evening, class. Thank you for bearing with me, but I cannot do anything because of this drilling project. Tomorrow they will continue, but we have no class, so I hope that by Thursday that will already be finished. Okay, I'm going to lecture on chapter 3. This is for 126 slides. But anyway, I will try to discuss most of this, but some in the ending part, I may just have it share screen so I can proceed to problem number 1. Separate and consolidated financial statements subsequent to the date of acquisition. So, meaning the next year after the date of acquisition. In the previous chapter, we have the date of acquisition. This chapter examines procedures for consolidating the financial statements of parent and subsidiary companies. Some differences in the consolidation process result from different methods of parent company accounting for subsidiary investments. Investments in voting stock of other companies may be consolidated or they may be separately reported in the financial statements at cost, at fair value or carrying value of equity. The method of reporting adopted depends on a number of factors, including the size of the investment, the extent to which the investor exercises control over the activities of the investee, and the marketability of the securities. Investor refers to a business entity that holds an investment in voting stock of another companies. Investee refers to a corporation that issued voting stock held by an investor or investors. Now we have the consolidated statements subsequent to the date of acquisition. The preparation of consolidated financial statements after acquisition is not materially different in concept from preparing them at the acquisition date, in the sense that reciprocal accounts are eliminated and remaining balances are combined. Now, one of the reciprocal accounts that is eliminated is investment account. So that is still applicable to consolidated statements subsequent to date of acquisition. The process is more complex, however, because time has elapsed and business activity has taken place between the date of acquisition and the date of consolidated statement preparation. On the date of acquisition, the only relevant financial statements is the consolidated balance sheet. After acquisition, a complete set of consolidated financial statements, statement of comprehensive income and retained earnings. So we have now the only relevant financial statement is the consolidated balance sheet. After, then we already have a complete set of financial statements. Separate financial statements. PS 27, paragraph 4, defines separate financial statements as those presented by a parent, an investor in an associate, or a venturer in a joint controlled entity in which the investments are accounted for on the basis of the direct equity interest rather than on the basis of the reported results and the net assets of the investees. In other words, the asset on the investor's balance sheet is the direct interest in the investment itself. So, in other words, the asset on the investor's balance sheet is the direct interest in the investment itself. Okay, now the following level of reporting is described in Table 3-1, wherein a parent company produces its own single economic financial statements or consolidated financial statements. Table 3-1 summarizes the accounting treatment required at each levels of reporting for consolidated financial statements purposes. So we have now the type of investment. Then we have the criteria. Investors separate financial statements, consolidated financial statements, and required treatment in group accounts. So we have now your consolidated financial statements. If the investment is in a subsidiary, the criteria is 51% or more, or let's say more than 50%. Then the P is 27. Investment is carried at cost or in accordance with PFRS 9 financial instrument using the equity method. PFRS 10, investment is eliminated and net assets of subsidiary are consolidated with those of the parent, and full consolidation in the consolidated financial statements. If the investment is in an associate, then we have a significant influence if the investment rate is 20% to 50%. So PS 27 and 28 investments carried at cost or in accordance with PFRS 9 financial instrument or using the equity method. In the consolidated financial statements, PS 28 or PFRS 10, investment is accounted for using the equity method and equity accounting is used. Now, if the investment is a joint venture, we have the criteria is contractual arrangement or joint control, though it may be 20 to 50% investment rate, just like the investment in an associate. Then P is 27 bar 28. PFRS 11 investment is carried at cost or in accordance with PFRS 9 financial instrument using the equity method. Then we have PS 28, PFRS 10 or PFRS 11 investments accounted for using the equity method, and it's still equity accounting. Now, if the investment, which is none of the three above, then the asset is held for accretion of wealth. We use PFRS 9 and as for a single company accounts. Now, as here we have an asterisk with one asterisk. A contractual arrangement must exist which establishes joint control. Now with two asterisks, fair value option. Accounting for subsidiaries, associates, and joint ventures in the parent's separate financial statements. A parent will usually produce its own single company financial statements, and these should be prepared in accordance with PS 27, separate financial statements. In these statements, investment in subsidiaries, associates, and joint ventures included in the consolidated financial statement should be either at cost or in accordance with PFRS 9 or fair value option, or using the equity method as described in PS 28, where subsidiaries are classified as held for sale. They should be accounted in accordance with PFRS 5. The equity method will be discussed in detail on the later part of this chapter. The approach in accordance with PFRS 9 refers to the fair value option or model will be discussed on the latter part of this chapter. Okay, so we have now your accounting for subsidiaries, associates, and we have your joint ventures in the parent separate financial statements. Okay, so we have now in at cost in accordance with PFRS. Okay, connecting. Okay, although there appears to be significant differences between cost model, equity method, and fair value option method, the main difference is timing. Table 3-2 shows a comparison of the three methods. So we have now the three methods for accounting for subsidiaries, associates, and joint ventures in the books of the acquirer or investor. So we have now the cost of investment, column 1, cost model, second, equity method, and fair value option. So the cost of investment, we have the same entries where we debit investment and credit various credits. It may be cash, it may be payable, now it may be an equipment. So in other words, we have various credits. Then for the results of operations, letter A, the net income of subsidiary under the cost model, there is no entry. Under the equity method, we debit to investment in subsidiary and credit to investment income. Now that is under the equity method. For fair value option, there is no entry. So it's only under the equity method where you have a debit to investment and to credit investment income. Now take note what is the effect of this entry. Under the equity method, the investment account is increased. It's increased due to the net income of the subsidiary. Now, for the cash dividend of subsidiary, then under the cost model, we debit to cash or dividends receivable or dividend debit cash or dividends receivable. Then we credit to dividend income or we have subsidiary. Uh, okay, let's continue. Now, if we are now trying to compare the accounting for subsidiaries, associates, and joint ventures in the books of the acquirer or investor. So, in recording the net income of the subsidiary, we have no entry under the cost model. In other words, the investment account will not change, while under the equity method, for net income, we debit to investment and to credit investment income. So this means that the investment account will be increased because of the net income of the subsidiary. While under the fair value option, just like under the cost model, there will be no entry. Now, for the cash dividend of the subsidiary, then under the cost model, the entry will be to debit cash or dividend receivable. Remember, it's the subsidiary giving the dividend. So, debit to cash or debit to dividends receivable and credit to dividend income or credit to subsidiary income, and the credit may be to investment income. Now, for the cash dividend, while for the equity method, the entry will be to debit cash or dividend receivable and credit subsidiary investment income. So the credit is to investment income for the cash dividend of the subsidiary. Now, while under the fair value option, a debit is to cash or dividend receivable, then credit to dividend income or subsidiary income, and credit to investment income. So, in other words, the entry under the cost model is the same as that under the fair value option. Now, for the amortization of the allocated excess, there will be no entry under the cost model, while under the equity method, we now debit to subsidiary or investment income, so that will decrease investment income and credit to the investment account. Now, under the fair value option, there is no entry, no special treatment is accorded for the allocated excess. Okay, now the impairment of goodwill under the cost model, there will be no entry. Under equity method, the entry is to debit subsidiary or investment income and to credit investment. So just like the entry for the amortization of the allocated excess. Again, there is no entry under the fair value option. Under the fair value option. Okay, so take note, these are very important entries that you need to master so you can properly prepare them in the problems. Now, the first method is the cost model, or formerly the cost method or the initial value method. PES 27 does not define cost except in the specific set of circumstances of certain types of group reorganization and in first-time transition to PFRS. In PFRS 3, the term cost no longer refers to cost of an acquisition, so the relevant measure will be 1. The consideration transferred, discussed in Chapter 1, and another point of reference might be PS 32, Financial Instruments Presentation, and PFRS, okay, 9. PFRS 9. Okay, investments in subsidiaries, associates, and joint ventures, while outside the scope of PS 32 and PFRS 9, are clearly financial assets and therefore financial instruments as defined in those standards. The cost model method of accounting for the intercorporate investments is consistent with the historical cost basis for most other assets. Now, under the cost model is subject to the usual criticisms leveled against historical cost. The cost model method does conform more closely to the traditional accounting and legal views of the realization of income. It is the most common method used in practice by parent companies. Typically, the correct income of the subsidiary is not known until after the end of the accounting period. Awaiting its determination would delay the parent company's closing procedures. It should be noted that for purposes of preparing consolidated statements, companies that use the cost model should be converted to equity method. So we have now, for purposes of preparing consolidated statements, companies that use the cost model should be converted to equity method. When the cost model is used, the investment in subsidiary account is retained at its original cost of acquisition balance. No adjustments are made to the account for income as it is earned by the subsidiary. Income on the investment is limited to dividends received from the subsidiary. The cost model is acceptable for subsidiaries that are to be consolidated because in the consolidation process, the investment account is eliminated entirely and results of operations for cost model, dividends declared or paid under this model, the only result of operation that should be recognized is only the cash dividend declared or paid. PFRS 3, paragraph 38A states that an entity shall recognize a dividend from a subsidiary, joint venture, or associate in profit or loss in its separate financial statements when its right to receive the dividends is established. The effect of these changes is that all dividends paid or payable by a subsidiary to a parent to be recognized as revenue by the parent. Remember the cost model, equity method, and fair value option, later part of this chapter, are methods to record the investments after acquisition, and their differences of these methods depends on the subsequent entries for net income from subsidiaries' own operations, dividends declared or paid, amortization of allocated excess, impairment of goodwill, and intercompany sales of inventory in Chapter 4, and fixed and plant assets in Chapter 5. Now, the second method is the equity method. The equity method of accounting is essentially accrual accounting for equity investments that enable the investor to exercise significant influence over the investee. Results of operations, equity method, net income, dividends declared, paid, amortization of allocated excess, and impairment of goodwill, intercompany profit in inventory, Chapter 4, and unrealized gain or losses on intercompany sales of property and equipment in Chapter 5. Under this method, record the investments at cost, adjust for earnings, losses, dividends declared and paid, amortization of allocated excess, over or under valuation, and goodwill impairment. In other words, the investment account balance will be adjusted due to these items. The investor reports his share of the investee's earnings as investment income and each share of the investee's losses as investment losses. Increase the investment account for investment income and decrease it for investment losses. Dividends received from investees are these investments under the equity method, and they are recorded as decreases in the investment account. Investment income under the equity method reflects the investor's share of the net income of the investee, and the investment account reflects the investor's share of the investment's net assets. Now take note, it's a very, very important statement. Investment income under the equity method reflects the investor's share of the net income of the investee, and the investment account reflects the investor's share of the investee's net assets. Although the equity method is not a substitute for consolidation, the income reported by a parent in its separate income statement under the equity method of accounting is generally the same as the parent share of or controlling interest in consolidated net income reported in consolidated financial statements for a parent and its subsidiary. This is the same with the reported net income determined under the equity method. The equity method of accounting is often called a one-line consolidation. A one-line consolidation. The name comes about because the investment is reported in a single amount on one line of the investor's balance sheet, and investment income, equity in subsidiary income, is reported in a single amount of one line of the investor's income statement, except when the investee has extraordinary or other below-the-line items that require separate disclosure. One-line consolidation also means that a parent company investors' income and stockholders' equity are the same when a subsidiary company investee is accounted for under a complete and correct application of the equity method, and when the financial statements of a parent and subsidiary are consolidated. Okay, consolidated financial statements show the same income. Okay, so consolidated financial statements show the same income and the same net assets, but include the details of the revenues and expenses and assets and liabilities. The equity method creates many complexities. It requires the same computational complexities encountered in preparing consolidated financial statements. The parallel one-line consolidation coverage permits us by making alternative computations of such key financial statement items as controlling interest or parent share in consolidated net income and consolidated retained earnings. So we have the parallel one-line consolidation. Okay. Uh, Basic accounting procedures for applying the equity method are the same whether the investor has the ability to exercise significant influence or joint control over the investee 20% to 50% ownership, or the ability to control the investee more than 50% ownership. This is important because investments of more than 50% are consolidations and require preparation of consolidated financial statements. So this refers to investments more than 50%. Here, thus the accounting principles that apply to the acquisition method of accounting for business combinations also apply to accounting for investments of 51% or greater under the equity method. Comparison worksheet approach between cost and equity methods. So we have now the item. The investment balance under the cost model is the cost, while under the equity method, it's the cost plus parent percentage of sub income minus dividends minus amortization of allocated excess minus goodwill impairment loss in case of partially owned subsidiary. It depends on full or partial goodwill approach. Adjustment needed to eliminate. Convert to equity method so the date of acquisition first year not needed. There's none for the equity method. For the elimination entry, eliminate beginning of year balance. Eliminate beginning of year balance. So they are the same. Allocated excess distribution, original amount from schedule of determination, and allocation of excess. Under the equity method, remaining unamortized balance from schedule of determination and allocation excess. Amortization of excess. Prior year retained earnings, current year to nominal accounts, only current year to nominal accounts. Goodwill impairment loss, prior year retained earnings, current year to nominal accounts, only current year to nominal accounts. Now, the amounts in the consolidated financial statements are amounts appearing in the books of parent company under the equity method, which ensure particularly the following aspects. The parent company's net income as reported is exactly equal to the controlling interest in consolidated net income on the consolidated financial statements. So the parent company's net income as reported is exactly equal to the controlling interest in consolidated net income in on the consolidated financial statements. The parent company's retained earnings is exactly equal to the consolidated retained earnings on the consolidated financial statements. Now take note, the amounts appearing in the consolidated financial statements are amounts appearing in the books of parent company under the equity method, which ensure particularly the following aspects. The parent company's common stock is exactly equal to the consolidated common stock on the consolidated financial statements. The parent company's additional paid-in capital is exactly equal to the consolidated additional paid-in capital on the consolidated financial statements. The parent company's dividends declared or paid is exactly equal to the consolidated dividends declared or paid on the consolidated financial statements. Determination of the method being used. Before you attempt to prepare a consolidated worksheet, you need to know which of the two methods is being used by the parent to record its investment You cannot begin to eliminate investment in subsidiary until it is determined. The most efficient approach is as follows. Test for the use of the cost model. If the investment account will be at the original cost shown on the schedule of determination and allocation of cess, the parent will have recorded as its share of subsidiary income its ownership interest times the subsidiary dividends declared or paid by the subsidiary. In most cases, this income will be called subsidiary dividend income, but some may call it subsidiary income or dividend income. Therefore, do not rely on the title of the account. If the method is not a cost model or method, check for the use of the equity method as follows. The investment account will not be at the original cost. The parent will have recorded as investment income its ownership percentage times the reported net income of the subsidiary less the amortizations of its cess and goodwill impairment loss for the current period, if any. Now, choosing between cost method and the cost model and equity method, consolidated financial statement amounts are the same regardless of whether a parent company uses the cost model or the equity method to account for subsidiaries' operations. Although there appears to have significant differences between the cost model and the equity methods, the main difference is one of timing. Eventually, the flows of income that flow from each method are the same. The cost model is slower in recognizing income. The working paper eliminations used in the two methods are different, as illustrated in subsequent sections of this chapter. The following table shows the impact of the basis of measurement on goodwill impairment test, basis of measurement of non-controlling interest and goodwill impairment. So we have now the item goodwill in consolidated financial statements, non-controlling interest at fair value at acquisition date, where you have full goodwill. Second column, non-controlling interest as a proportion of identifiable assets at acquisition date or with partial goodwill. Goodwill in consolidated financial statements includes non-controlling interest share of goodwill, does not include non-controlling interest share of goodwill. Carrying amount of cash generating unit, goodwill is allocated to cash generating unit without further adjustments. Goodwill is to be grossed up to include non-controlling interest share, notionally adjusted goodwill, recognized goodwill parents' interest. Now for the impairment loss. Impairment loss is shared between parent and non-controlling interest on same basis on which profit or loss is allocated. Impairment loss is borne only by parent as goodwill for non-controlling interest is not recognized. One item to be recognized under equity method is that the parent company might opted not to record the goodwill impairment loss. Now, goodwill impairment test, PES 36, impairment of assets, requires goodwill to be reviewed annually for impairment loss because goodwill is an integral asset in a business unit. It's not assessed for impairment as a standalone asset, but is reviewed for impairment as part of a cash-generating unit. IFRS 3 allows two bases of measurement of non-controlling interest as of acquisition date, such as either option 1 non-controlling interests are measured at full fair value, full goodwill approach, or fair value basis. Option 2 non-controlling interests are measured at proportionate share of full goodwill, partial goodwill approach, or proportional basis. So we have now options 1 and 2. Now, how is goodwill impairment losses counted under the equity method for consolidation purposes? How is goodwill impairment loss handled? How is goodwill impairment loss recorded? The impairment loss is reported in the consolidated income statement for the period in which it occurs. It's presented on a before tax basis as part of continuing operations and may appear under the caption Other Gains and Losses. The parent company could handle the impairment loss in two ways. The parent could record the impairment loss on its books and credit the investment in subsidiary account. This would mean that the impairment loss would already exist before consolidation procedures start. The NCI share of the loss in case of full goodwill approach would be recorded on the worksheet. The procedure used in this text will be to follow option 1, NCI at full fair value, full goodwill, and directly adjust the investment account on the parent's books. Now, the impairment clause could be recorded only on the consolidated worksheet. The investment account, resulting goodwill, and the controlling retained earnings would be overstated. Thus, on the worksheet, an adjustment reducing the goodwill account and the controlling retained earnings would be needed. Consolidated statements subsequent to date of acquisition. The preparation of consolidated financial statements after acquisition is not materially different in concept from preparing them at the acquisition date, in the sense that reciprocal accounts are eliminated and remaining balances are combined. On the date of acquisition, the only relevant financial statement is the consolidated balance sheet. After acquisition, the complete set of consolidated financial statements, statement of comprehensive income, and retained earnings statement. Now we have the work paper format. Accounting work papers used to accumulate, classify, and arrange data for a variety of accounting purposes, including the preparation of financial reports and statements. Although work paper style and technique vary among firms and individuals, we have adopted a three-section work paper for illustrative purposes. The format includes a separate section for each of the three basic financial statements: income statement, retained earnings statement, and balance sheet. In some cases, the input to the work paper comes from the individual financial statements of the affiliates to be consolidated, in which case the three-section work paper referred to illustrations below is particularly appropriate. Now, nature of eliminating entries. The investment account must be eliminated in the consolidated financial statements because, from a single entity viewpoint, A company cannot hold an investment in itself. The subsidiary stock and the related stockholders' equity accounts must be eliminated because the subsidiary stock is held entirely within the consolidated entity and none represents claims by outsiders. From a somewhat different viewpoint, the investment account on the parent's books can be thought of as a single account representing the parent's investment in the net assets of the subsidiary, a so-called one-line consolidation. In full consolidation, is subsidiaries' individual assets and liabilities are combined with those of the parent, including both the net assets of the subsidiary as represented by the balance in the investment account and the subsidiaries' individual assets and liabilities would be double count the same set of assets. Therefore, the investment account is eliminated and not carried to the consolidated balance sheet. To achieve the elimination of the investment account, eliminating entries are required. Eliminating entries are used in the consolidation worksheet to adjust the totals of the individual account balances of the separate consolidation companies to reflect the amounts that would appear if all the legally separate companies were actually a single company. Eliminating entries appear only in the consolidation worksheets and do not affect the books of the separate companies. Consolidated financial statements should include only balances resulting from transactions with outsiders. Eliminating techniques are designed to accomplish this end. Consolidated income statement is essentially a combination of the revenue, expense, gain, and loss accounts of all consolidated affiliates after elimination of amounts representing the effect of transactions among the affiliates. The combined income of the affiliates after eliminating any intercompany transactions is referred to as consolidated net income. This amount is allocated to the controlling and non-controlling interest. In the work paper, consolidated net income is reduced by the non-controlling interest share, if any, of the net income of the subsidiaries to arrive at the controlling interest in consolidated net income. Consolidated net income under the entity theory, all revenues and expenses of the individual consolidating companies arising from transactions and actions with unaffiliated companies are included in the consolidated financial statements. The consolidated income statement includes 100% of the revenues and expenses regardless of the parent's percentage ownership. As with single company financial statements, where the difference between revenues and expenses equals net income, revenues minus expenses in the consolidated financial statements equals consolidated net income. If all subsidiaries are wholly owned, all of the consolidated net income accrues to the parent company or the controlling interest. If one or more of the consolidated subsidiaries is less than wholly owned, A portion of the consolidated net income accrues to the non-controlling shareholders. Consolidated retained earnings statement. The consolidated retained earnings statement consists of beginning consolidated retained earnings plus the controlling interest in consolidated net income or minus the controlling interest in a consolidated net loss minus parent company dividends declared. The net balance represents consolidated retained earnings at the end of the period. The non-controlling interest in net assets is reflected as a separate component of equity. Non-controlling interest of a less than wholly owned subsidiary have a claim on the income and net assets of the subsidiary even though the subsidiary is consolidated with its parent and perhaps other subsidiaries. Work paper observations should be noted concerning the work paper presented in the succeeding illustrations. Each section, the work paper, presents one of three consolidated financial statements. Elimination of the investment account, allocated excess, the difference between fair value of the subsidiary and book value. The fair value and the consideration transferred of a subsidiary might have exceeded the book value for several reasons, such as excess of fair value over book value of the subsidiary's net identifiable assets. This valuation may be accomplished each period in the consolidated worksheet and existence of goodwill. The second elimination entry is also identical to that which would have been at the date of acquisition. It serves to distribute the difference between the fair value of the subsidiary and book values of subsidiary equity to the appropriate accounts, in this case to goodwill. Intercompany dividends, non-controlling interest in consolidated net income. The elimination columns in each section do not balance since individual eliminations made involve more than one section. The total eliminations for all three sections, however, must be in balance. Consolidated financial statements with partially owned subsidiaries. The consolidation process for a partially owned subsidiary is the same as for a wholly owned, except that the claims of the non-controlling interest must be included. Illustration 3-1, 80% owned subsidiary cost model partial goodwill approach. Assume that on January 1, 2004, Perfect Company acquires 80% of the common stock of Sun Company for 310,000. At that time, the fair value of the 20% non-controlling interest is estimated to be 77,500. On that, the following assets and liabilities of Sun Company had book values that were different from their respective market values. So the inventory, land, equipment, buildings, we have bonds payable. Now we have the fair values or market values different from their book values. So except for equipment. So in other words, we have undervaluation over valuation. All other assets and liabilities had book values approximately equal to their respective fair values. January 1, 20x4, the equipment in buildings had remaining life of 8 and 4 years, respectively. And we have the inventory is sold in 20x.54 inventory costing method issues. Goodwill, if any, is reduced by a 3,125 impairment loss during 20x4 based on the fair values basis or full goodwill, meaning the management has determined that the goodwill arising in the acquisition of Sun Company relates proportionately to the controlling and non-controlling interest, as does the impairment. Trial balances for the companies for the year ended December 31, 2024 are as follows. So we have now Perfect Company and Sun Company. Take note, we have now the assets, the liabilities, and we have included among the assets is investment in Sun Company for 310,000. Then we have depreciation, a discount on bonds payable. Then it's still a blank. Depreciation expense of the parent and the subsidiary. Then we have other expenses and dividends paid. Accumulated depreciation of equipment and buildings. Then accounts payable, bonds payable, common stock, retained earnings, sales, and dividend income. From the trial balances presented above, the following summary for 20x4 results of operations are as follows. So we have now the results of operations. Perfect Company had net income of 164,000 after adding dividend income. And Sun Company has net income of 50,000. Okay, so we have now the resulting ownership situation can be viewed in the schedule of determination and allocation of excess, schedule of determination and allocation of excess, partial goodwill, date of acquisition, January 1, 20x4. So we have now the fair value of subsidiary, the consideration transferred of 310,000. Book value of stockholders' equity of Sun, common stock, and retained earnings. And we have now the allocated excess. Excess of cost over book value. Then we have the over-under valuation of assets and liabilities. Increase in inventory, it's to be multiplied by 80%. Each of these under overvaluation should be multiplied by 80% because of the interest acquired by the parent. So we have now a decrease in building for 80% of 20,000. And we have now decrease in bonds payable. So the positive excess using the partial goodwill approach, the excess of cost over fair value. The over-under valuation of assets and liabilities are summarized as follows. So we have now inventory, land, equipment, buildings, and bonds payable. Now this where the data were given in the earlier part of the problem. Now, the buildings and equipment will be further analyzed for consolidation purposes. So, we have now the equipment. The book value is 70,000, but the fair value is 150,000. Then the building, 140,000 and 120,000. Now, we have a summary of depreciation and amortization adjustments. So we have now for inventory that's good for 1 year, following the FIFO basis, subject to annual depreciation, the equipment, the adjustment in the equipment. We have the amount of the undervaluation of 80,000, the remaining life of 8 years. So we have the annual amortization of the undervaluation of 10,000. Then the building, the undervaluation of 20,000 divided by 4 or 5,000, and the bonds payable 4,000 divided by 4 or 1,000. Now the goodwill impairment loss of 3,125 based on 100% fair value would be allocated to the controlling interest and the non-controlling interest based on the percentage of total goodwill each equity interest received. For purposes of allocating the goodwill impairment loss, the full goodwill is computed as follows. So we have now the fair value of subsidiary, the consideration transferred, then we have the fair value of the NCI. Total fair value of subsidiary is 387,500. Then we have to deduct the book value of the stockholders' equity of SAN with a total of 300,000. So the allocated excess of cost over book value, but we have to deduct the over-under valuation of assets and liabilities adjustment to fair value. So we have now the positive excess using the full goodwill approach in the amount of 12,500. In this case, the goodwill was proportional to the controlling interest of 80% and non-controlling interest of 20%, computed as follows. The goodwill applicable to parent, so we have now the value percent of total is 80% and applicable to the non-controlling interest equal to 20%. So we have now the total of full goodwill of 12,500 as computed above. The goodwill impairment loss should be allocated as follows. So we have now goodwill impairment loss attributable to parent or controlling interest of 2,500 as computed applicable to parent or controlling interest, and we have now the goodwill applicable to the NCI equal to 625. So we have now the goodwill impairment loss based on 100% fair value or full goodwill. When cost model issues, only 2 journal entries are recorded by Perfect Company during 20x4 related to its investment in Sun Company. Now using the cost model. First year after acquisition, parent company using the cost model. When the cost model issues, only 2 journal entries are recorded by Perfect Company, the parent, during 20x4 related to its investment in Sun Company. Entry 1 records Perfect Company's purchase of Sun Company stock Entry 2 recognizes dividend income based on 32,000 or 40,000 times 80% of dividends received during the period. So the entries of the parent, we have debit to investment in Sun Company for 310,000 and credit to cash. Then, record dividend income for the dividends received from Sun, debit to cash and credit to dividend income. Now we are using the cost model. On the books of the Sun Company, the 40,000 dividends paid was recorded as debit to dividends paid and credit to cash, whereas only 32,000 of the dividends paid by the subsidiary, only 32,000 goes to the parent while the 8,000 goes to the non-controlling interest. The dividends paid or declared account is a temporary account that's close to retained earnings at year-end. An alternative is to debit retained earnings directly when dividends are paid or declared. No entries are made on the parent's books to depreciate, amortize, or write off the portion of the allocated excess that expires during 20x4. Now, consolidation work paper, year of acquisition, schedule of determination and allocation of excess presented above provides complete guidance for the worksheet eliminating entries on January 1, 20x4. So we now debit to common stock of the subsidiary retained earnings, then credit to investment in Sun and non-controlling interest for 60,000. To eliminate intercompany investment and equity accounts of subsidiary on date of acquisition and to establish non-controlling interest in net assets of subsidiary. Then we now record the undervaluation, overvaluation, debit to inventory. We are debiting because the fair value is 5,000 higher than the book value. Debit to accumulated depreciation. We are debiting because the equipment's fair value is 80,000 higher than the book value. So we debit to accumulated depreciation to reduce the balance of the account so that the fair value will be equal to the amount given. The same with buildings. We debit to land for the undervaluation, debit to discount on bonds payable, the difference between the fair value and the book value of the bonds, debit to goodwill, credit to buildings, credit non-controlling interest, and credit to investment in Sun Company. To allocate excess of cost over book value of identifiable assets acquired with remainder to goodwill and to establish non-controlling interest in net assets of subsidiary. So we now debit to cost of goods sold, debit to depreciation expense, debit to accumulated depreciation of buildings, debit to interest expense, goodwill impairment loss, and credit to inventory, accumulated depreciation of equipment, discount on bonds payable, and credit to goodwill to provide for 20x4 impairment loss and depreciation and amortization on differences between acquisition date, fair value, and book value of Sun's identifiable assets. Okay, so we have now the following entries. Debit inventory as sold. So we debit to cost of goods sold and equipment for the additional depreciation. A building we are now reducing by 5,000 and bonds payable for the amortization. Now it should be observed that the goodwill computed above was proportional to the controlling interest of 80% and non-controlling interest of 20% computed as follows. So we have now the full goodwill, total full goodwill. Therefore, the goodwill impairment loss of 3,125 based on 100% fair value or full goodwill will be allocated as goodwill impairment loss attributable to parent 2,500 and applicable to NCI of 625. So we have now the impairment loss of 3,125. And we debit to dividend income of perfect, non-controlling interest 6,000 and credit dividends paid by son of 30,000 to eliminate intercompany dividends and non-controlling interest share of dividends. Then, non-controlling interest in net income of subsidiary, we now debit and credit non-controlling interest 7,800 to establish non-controlling interest in subsidiaries adjusted net income for 20x4 as follows. Net income of subsidiary, then we deduct amortization of allocated excess, and we multiply by the percentage of non-controlling interest at 20%. Subsidiary accounts are adjusted to full fair value regardless of the controlling interest percentage or option used to value non-controlling interest or goodwill. The trial balance data for Perfect and Sun Company are entered in the consolidation work paper that separate financial statements of the two companies. The eliminating entries and the consolidated totals for the financial statements on December 31, 20x4. Now we have the figure 3.1, the worksheet for consolidated financial statements at the end of the year, cost model, partial goodwill, 80% owned subsidiary. Now this is at the end of the year, first year after acquisition. So we have now Perfect Company, Sun Company, and then we have the adjustments and eliminations and the consolidated balances. So we have the sales of the parent and the subsidiary, total of 600,000. Let's try to trace the elimination entries. Elimination entry number 1, we now debit to common stock of the subsidiary for 200,000. Then we debit retained earnings of the subsidiary for 100,000. So numbers 100,000 and 200,000. The corresponding credit in number 1 is to credit investment in Sun Company 240,000 and non-controlling interest for 60,000. That's 20% of 300,000. So again, the entry is to debit retained earnings January 1, 100,000. Then debit common stock 200,000. So total debit of 300,000. Then we credit to number 1, credit investment in Sun Company 240,000 and credit non-controlling interest 60,000. Then we go to entry number 2, debit inventory 5,000, debit land 6,000, debit buildings, debit discount on bonds payable 4,000, then debit goodwill for 10,000, debit accumulated depreciation of the equipment 80,000, debit accumulated depreciation of the buildings 160,000, and debit non-controlling interest for 6,000. So we have now numbers two. Number 2, we have 5,000, 6,000, 4,000, 10,000, 80,000, 160,000, and 6,000. Now for the credit, we have 180,000. That's for the buildings and investment in Sun Company for 70,000, and we have to credit non-controlling interest for 15,000. Then for entry number 3, we now debit to cost of goods sold, debit depreciation, debit interest expense for the amortization of discount. So that's number 3. Then debit goodwill impairment loss for 2,500, and to debit accumulated depreciation of buildings. Number 3 is 5,000. Then we credit number 3, credit inventory for 5,000, credit discount on bonds payable, credit 1,000, credit goodwill for 2,500, and then credit accumulated depreciation equipment for 10,000. Now, these are your debits and credits in number 3. Then, for number 4, we debit to dividend income, and that's number 4 debit, and we have a credit to a dividend income, no? So, first, we debit to dividend income for 24,000. Okay, debit to dividend income for number 4, 24,000 dividend income. And then we credit to retained earnings, dividends paid. Dividends paid number 4, 30,000. So we have now the credit in number 4 of 30,000. That's a credit to dividends paid. That's in number 4. And in number 4, we have dividend income for 24,000. That's in the books of Perfect Company, 24,000. So dividend income is already eliminated. So take note, that's number 4, and we have to credit dividends paid by Sun Company. Number 4 is an amount of 30,000. 30,000. But here, we have the non-controlling interest in the amount of 6,000. the non-controlling interest for 6,000, while the dividends paid equals 30,000. That's number 4. In dividend income of the parent is 24,000. Now we are eliminating it. And we have now the entries for number 5. Debit number 5, NCI, net income, subsidiary, 7,800. Number 5. So we have again the entry is NCI net income of subsidiary number 5, 7,800. And we have now non-controlling interest number 5, 7,800. Now, after the adjustments and eliminations, you can already forward the balances to the consolidated statements. Like sales, 400 plus 200, so you get 600. And you have to go downward, uh, check the correctness of the amounts. The consolidated net income and non-controlling interest in consolidated net income, which can be verified in figure 3-1, can also be computed as follows. So we have now the net income from own separate operations, the parent, subsidiary company. So we have the total. Then we have to deduct the non-controlling interest, amortization of allocated excess in the amortization computations. Then we have the goodwill impairment under partial goodwill approach. So the difference is the controlling interest in consolidated net income or profit attributable to equity holders of parent, and we add the non-controlling interest in net income. Then we have now the non-controlling interest in net income. Net income of subsidiary company of 50,000, and we have to deduct the amortization of allocated excess, goodwill impairment, refer to the amortization table above, then multiplied by a percentage of non-controlling interest. Since NCI share of goodwill is not recognized, no adjustment is required for the impairment loss on goodwill, and impairment losses are not shared with NCI. On date of acquisition, the retained earnings of parent should always be considered as the consolidated retained earnings. So we have now the consolidated retained earnings of parent, date of acquisition, 300,000. On subsequent to date of acquisition, consolidated retained earnings would be computed as follows. So we have now the consolidated retained earnings of parent, 300,000. Then we add the controlling interest in consolidated net income or profit attributable to equity holders of parent for 20x4. Then we have the total. We deduct the dividends paid parent company for 20x4. We have the consolidated retained earnings. Then we have now the non-controlling interest, the common stock, the retained earnings. We have the total. Then the adjustments to reflect over under valuation of assets. We have now the fair value of stockholders' equity of subsidiary on January 1, 20x4. We multiply by 20%, the non-controlling interest rate. The goodwill recognized on consolidation purely relates to the parent share. NCI is measured as a proportion of identifiable assets and goodwill attributable to NCI is not recognized. So we have now the non-controlling interest, common stock, 200,000, the retained earnings, 100,000, and we add the net income. So the total of 150,000. We deduct the dividends paid of 30,000. We have now 120,000. That's the retained earnings of the subsidiary company. So we have now the stockholders' equity of the subsidiary company on December 31, 20x4. Then adjustments to reflect fair value, and we deduct the amortization. We have the fair value of the stockholders' equity of subsidiary at the end of the year multiplied by 20%. So we have now the non-controlling interest using partial goodwill. Alternatively, NCI on December 31, 20x4 may also be computed as follows: non-controlling interest 75,000, then we add non-controlling interest net income 7,800, then we have dividends on 30,000 times 20%, non-controlling interest partial at the end of the year. Then the second year after acquisition, assume the following information available for Perfect and Son Company for the year 20x5. So we have now the sales, cost of goods sold, then we have depreciation, other expense, net income from its own separate operations. Then we add dividend income, and we have the net income of the parent and the subsidiary in their separate statements. So likewise, we have the dividends paid. Parent company cost model entry. Only a single entry is recorded by the parent in 20x5 in relation to its subsidiary investments. So debit to cash and credit to dividend income at 80%. On the books of the Sun Company, the 40,000 dividend paid was recorded as debit to dividends and credit to cash. The trial balance data for Perfect and Sun Company are entered in the consolidation work paper on December 31 as shown in figure 3-1. Investment in Sun Company, credit to retained earnings, to provide entry to convert from the cost method to the equity method, or the entry to establish reciprocity at the beginning of the year. Retained earnings, Sun. Then we have the retained earnings, beginning and ending, then increase multiplied by the controlling interest, so retroactive adjustment of 16,000. Why is an adjustment to the beginning retained earnings required? In the statement of changes in equity, the opening balance of retained earnings has to be adjusted to arrive at the same balance that was reported in the previous financial statements. This entry may be viewed as either the entry to convert from the cost model to the equity method to establish reciprocity at the beginning of the year. The following two options explain this essentially complementary views of the entry. The reciprocity entry adjusts Perfect Company's beginning retained earnings balance on the work paper to the appropriate beginning consolidated retained earnings amount. As indicated earlier, consolidated retained earnings on January 1, 2025 consists of perfect companies' reported retained earnings plus perfect company's share of the undistributed earnings, so income less dividends of Sun Company from the date of stock acquisition to the beginning of 20x. 4. If this entry is viewed as a conversion to the equity method, the following questions might well arise. Why should we convert to the equity method if all methods are acceptable and all yield the same final results? Recall that under the equity method, the parent records its investment income in its income statement and ultimately in its retained earnings. If we consider the two accounts in the conversion entry, it is true that the investment is going to be eliminated to zero anyway. But the retained earnings account of the parent company, which must ultimately reflect investment income, will not be eliminated. Instead, it needs to be adjusted if the cost model or the cost method is used. Although it's true that the investment account must be eliminated after it is adjusted, the reciprocity conversion entry facilitates this elimination. The amount needed for the work paper entry to establish reciprocity can be most accurately computed by multiplying the parent company's percentage of ownership times the increase or decrease in the subsidiaries' retained earnings from the date of stock acquisition to the beginning of the current year. Now we debit to common stock, debit to retained earnings of the subsidiary, then credit to investment in stock at 80% and credit to non-controlling interest. To eliminate intercompany investment and equity accounts of subsidiary and to establish non-controlling interest. Now, debit to inventory, accumulated depreciation, equipment and buildings, debit to land, debit to discount on bonds payable, debit to goodwill, credit to buildings, non-controlling interest, investment in Sun Company. To allocate excess of cost over book value of identifiable assets acquired with remainder to goodwill and establish non-controlling interest. Retained earnings is debited for perfect company January 1. So we now have 11,000 times 80%. So that makes 8,800 plus 2,500 impairment loss on partial goodwill. Then we have to debit non-controlling interest, 2,200 debit to depreciation expense, debit to accumulated depreciation of buildings, debit to interest expense, credit to inventory, credit accumulated depreciation of equipment, debit, credit discount on bonds payable, credit to goodwill. To provide for years 20x4 and x5 depreciation and amortization on differences between acquisition date, fair value, and book value of Sun's identifiable assets and liabilities as follows. Year 20 export amounts are debited to perfect retained earnings plus NCI. Year 20 X5 amounts are debited to respective nominal accounts. So we now have 20 export retained earnings, depreciation, amortization, uh, here inventory sold, equipment, buildings, bonds payable, subtotal multiplied by, then we have the two retained earnings, impairment loss. We have the total of 11,300. We now debit to dividend income of perfect 32,000. Then we have the non-controlling interest of 8,000 and credit dividends paid Sun 40,000. Debit non-controlling interest net income of subsidiary 13,800 and credit to non-controlling interest. So net income of subsidiary, amortization of allocated excess. So we have the difference multiplied by 20%. The separate financial statements of the two companies, the eliminating entries and the consolidated totals for the financial statements are shown on figure 3-2. So we have now the income statement totals, then we have dividend income, we have the total revenue, then cost of goods sold to be deducted together with depreciation expense, interest expense, other expenses, and goodwill impairment loss. Total, we finally get the net income and net income of the non-controlling interest, net income of the subsidiary. So in this statement of retained earnings, parent, so we have the adjustments and eliminations. Then we have subsidiary. We have net income from above. And finally, the totals, dividends paid, Perfect Company and Sun Company. And we have now the retained earnings on December 31 to balance sheet. So we have now the balance sheet figures showing the adjustments and the eliminations. So finally, for the totals, now the consolidation, the consolidated columns with the totals. Total assets equals liabilities and stockholders' equity. Take note that we have eliminated the common stock of the subsidiary as well as its retained earnings. Okay, now the remaining slides, there are still a lot of this. I am going to share screen, no? So, para nga maka-upload, ma-convert pa, kag i-upload sa YouTube. Okay, so I hope you will study the remaining slides.